Hi everyone, I am Jeremy Reynolds, the money coach, your money coach from here live at the Getting Started in Finance course, discussing a topic which has been going around a lot in the media. We're discussing the problems, alerting you of some potential risks, and I'm going to do so just as much and going a few steps further, discussing interest-only home loans. So many of you out there probably have interest-only loans and haven't given much thought to your loan itself, the structure, as apart from having the loan or getting the loan. But today's discussion and training, what I'm going to provide for you is regarding a little thing called time. Is your time running out? Has the time run out for your interest-only loan to be the best possible solution for your individual scenario? Have you got a false sense of confidence or security based on purely being refinancing your loan and thinking, okay, it's going to all come down to my particular payment? So I've thrown a bit of information out there and I'll slow down just a little bit to help you grasp some of the things I'm saying. So look forward to sharing this with you. One of the other things to be certain of, I will put a disclaimer in here that everything I share today is for training purposes only and is general in nature. For all your individual needs, please make an appointment and talk with a credit representative who can take your needs into consideration and discuss them in the context of your individual situation and your goals, and provide relevant personal advice for your situation as well. But let's get back on topic. False sense of security or confidence, okay, with interest-only loans. I have seen countless examples of people who have an interest-only loan. So what's an interest-only loan? It's a loan that's particularly set up for a number of reasons. It's a loan that the individual isn't paying off the principal amount of their loan. They're getting a loan that has, for a set period of time, usually between 1 and 5 years, but let's just say that most people go for the maximum amount, 5 years, where they're only having to pay the interest component of their loan. Why? Either for tax purposes, and that's a separate topic and rationale in itself, or their reason is to keep their repayments lower on an investment property. Now, what is rarely discussed by the standard broker in a refinance situation, so refinance situation being that you, the client, you, the customer, has an interest-only loan. And whether the catalyst is yourself, whether it's the broker giving you an update, says it's time to review our loan situation. Typically, the loan situation will be this. Well, the interest-only component, the interest-only time frame, 5 years, is coming to an end. At that 5-year period, at the end of that time, the loan will revert to principal and interest. Now, the borrower, the customer, the client, you, now panics and says, well, I know when I took out the loan, I was either nudged or to present my information this way, or I told the broker that I'm going to earn more money in the future. After 5 years, she'll be right. I'll be able to pay principal and interest on my loan. Well, realistically, a very unethical conversation could have happened where it said, well, after 5 years, what we're going to do is, how about we just refinance you for another 5 years on an interest-only loan with another bank? And the client goes, well, this sounds good, not a problem. If this means my repayments stay low, yeah, why not? Now, there's a few real big dangers with this conversation. So we're going to take a brief step back in time to 5 years ago when they first got their loan. Now, this broker can only really give advice about what's current and what's in the present situation now. So they're not taking into account of the future market, which they can't, whether it's the property market or it is the market, if it's a finance market. So let's have a look at the interest rates. What are they going to be in 5 years' time? Are interest-only loans going to be available? Okay, are the rules or the policies of the banks going to change? Are you actually going to earn more? How are you going to earn more in 5 years' time? So let's look at this and let's identify it. So an interest-only loan should never be a position to take if it's for an affordability perspective on the loan. Never. Interest-only loans have an ability and have a position when there is a strategy component that's associated potentially with the investment, so through a financial planner and authorised representative, combined with potential tax benefits for doing so as well. But never purely from a credit perspective where the advice is given by the credit representative, the mortgage broker, that you should get an interest-only loan because you can't afford a principal and interest loan. That's a huge danger. So this client, if there wasn't a tax benefit or strategy or a financial planning and a goal-based strategy associated with this from people who are certified to give the advice, namely there was a tax agent and an authorised representative, a financial advisor or planner, then we need to look at the reasoning within credit why we'd take out the interest-only loan. In this case, based on this scenario for affordability, there should be warning bells going off, let alone in 5 years' time, encouraging the client that in 5 years' time, we can just refinance you into an interest-only loan. Now, the danger being, as I mentioned, we don't even know if, based on policy or your situation or markets, that this will actually be an available option in 5 years' time. What the interest rates will be in 5 years' time. And whether what's going to happen in 5 years' time at all. So, worst case scenario, you could get to 5 years' time and say, well, no, you can't refinance it purely based on what the banks are saying. Now, you've got to figure out a way to afford your loan that potentially you shouldn't have got in the first place because the broker didn't give you any of a long-time view, putting in the stipulations that is the goal, what is the end goal here? Is the goal to pay off some sort of the principal and interest? And if you're not looking at paying off the principal and interest, what is the tax or financial planning perspective attached to it? Now, let's say this client is not aware of any of these things and they've refinanced this a few times. So let's say it's now the third time they've done this. Okay, so 15 years, given that they've had 5 interest-only terms. Now, after 15 years, this client, first issue number 1, the client has not paid off any of their principal component of their loan. So what I'm saying is here, they have not paid off any of their loan. They've purely been paying interest to a financial institution for their loan. So if push came to shove, the only thing they've got to rely on here is potential value of the property going up, whether it has, whether it hasn't, and whether it's actually in line or can be taken into account versus what the interest they paid in that loan is. So have they actually got ahead at all? It might be unlikely that they have. Now, time always runs out. So now we've got 15 years of this happening, and the client has paid off interest. They still have to pay off the remaining debt. Now let's look at an issue associated with this. Time and age. One of the components of assessment criteria for clients, individuals or couples, people looking at getting a loan, is looking at their age. Now it's not about age and discrimination and who can and can't get a loan based on their age. No, it's about the associated risks of reaching a certain age, and let's say for argument's sake, mid-50s onwards, where financial institutions are wanting to look very closely at you and your ability to generate income to pay off debts for the next 25 to 30 years. So let's look at this. The individual's now 55 and they haven't paid off any of the principal component of their loan. And the bank's going to want to know questions like, well, how much longer, how long are you going to work for? Are you going to work for the next 25 to 30 years? Have you got the funds to pay off your loan over the next 25 to 30 years? Or we get to this point, now keeping in mind, we've still got the entire principal component of the loan remaining. Now, again, I'm seeing this external to there being a planning or tax strategy. Purely credit here and having a loan in place and associated risk. So the next thing we're looking at here, and they go, well, so now we're saying as a 55-year-old, say with a house of 400,000 that hasn't had any of the debt actually paid off, you're saying as a 55-year-old, you're probably going to have to start paying off your loan. And we don't think we're going to give you an interest only, because at 60, it's going to revert to principal and interest, and this is going to be a major risk for how you're going to pay it off. What will you do? So time will run out. Time will run out, and there must be either an exit strategy, in other words, an exit strategy for that property, an exit strategy of disposal of that property, selling of that property, which could be through a financial planner, and making sure there is an in-depth statement of advice for these things, working alongside the broker, but not purely for affordability reasons. This is really delaying the inevitable. And it's not just delaying the inevitable. And when I say that, you're actually, with this interest-only conundrum of this person just saying, let's just refinance it against interest-only, let's just refinance in interest-only, what we are actually doing is you're purely deferring the debt. What do I mean by deferring the debt? The debt is not going away. The debt will have to be paid off at some stage. So we've got two risks here. Being an interest-only component, the loan will be amortised. Meaning, if there is no refinance and it's a 30-year term, you now, for someone that's potentially made the point of affordability being an issue, they have a shorter term, 25 years, so 30 minus the 5 interest only, to pay off that total loan. So they actually need to catch up for those 5 years they've missed on principal for the remaining 25 years. So in other words, their payments are going to be higher. So that's if they go to the rate revert and they don't refinance. Or those that think that their parachute to when this plane is going down, plane being the interest-only loan, is their parachute, their rescue is to say, I'll just refinance it. Well, first of all, you may not be able to refinance it based on age, based on value of the property, based on potential future risk, and you may be left in a very precarious situation. So if you believe that you're facing any of these problems, now the first problem being that you're in an interest-only loan and you don't know whether it's the best possible structure or solution for you, please give myself or my team a call at Alpha Finance Solutions on 1300 541 777. And what we'd like to do is have an informal chat with you about your individual situation and what potential options there could be to improve, not only get you a loan, but improve your financial situation, help you get on track to achieve your financial goals, and minimise your risks in the process of doing so by taking a holistic financial view of you, including the mortgage broker, the tax agent, the accountant, and the financial planner, all the while walking you through this seamless process with these people to ensure that you're on track to achieve better things and not being put in unnecessary danger. I'm Jeremy Reynolds. I will make sure that this is placed on my podcast as well for future viewing. And I look forward to your content and questions. And if you do have any questions that you would like me to touch on in the videos, in my podcast, in my content, please write a comment, send me a private message, and I would love to put it out to the public as well and help everyone and help as many people as I can achieve their real estate, their property and their home loan goals.